I'm Mary Lyons, and I am the Wealth Woman.
And I'm Eric Alexander from Benchmark Income Group.
And this is the Big Wealth Podcast.
Everything you've ever been taught about money is wrong.
But don't worry, we're here to help.
On this podcast, we'll use the same tools you already know to actually help set you free.
Free to do what you want with your time, with your money, and with your energy. Free to live your life the way you have dreamt about.
So we're going to talk about wealth knowledge, personal reflections, and the financial industry news of the day.
Welcome to the Big Wealth. Hi, I'm Mary Lyons, the Wealth Woman.
And I'm Eric Alexander with Benchmark Income, and we are here today with the wonderful Andy Tuttle.
You forgot amazing.
Great, the wonderful and the amazing Andy Tuttle.
Welcome to the Big Wealth Podcast. We're really excited to have Andy with us today. He is my go-to for all information related to mortgages. He is a mortgage banker, and I am making sure I get that correctly. But he knows all kinds of things about how you should structure a mortgage, what you should and shouldn't do. And he has been a great resource for us. So today we are really happy to get to share him with you.
Well, and I appreciate you guys having me.
Yeah.
So Eric, why don't you lead us off? I know you have some specific questions for Andy.
Yeah, well, Andy and I went through this process with our family, a month ago, 2 months ago. The days all sort of flowed together. But it was such a cool process. I mean, it was such a kind of I haven't done that in a number of years, right? Since we bought our house. But one of the cool things that you did, I thought that was really neat, was sort of that your super cool video with, if you did this, if you did this, if you did this, and the nerd in me just geeked out on all of it, right? But what if we did this and this, right? But one of the things that I thought was really fascinating was that idea of points. Like, for some reason, that's the one part of that I've always been confused on. It seems like why would you ever do that? But it's there and it has to be there for a reason. So when do you do one versus the other? What's your kind of theory on points? I know that's always the weird one for me.
Yeah, that's a great question. Frankly, we do get that question all the time. And one of the reasons we get that question is most lenders when they market rates online, they're always quoting it with a point or 2 points, which is 1 point equals 1% of the loan amount. So sometimes it's a half a point, 0.5% of the loan amount. Sometimes it's more, whatever, but that's the baseline. But to make rates look better, they always quote that, right? So people get used to paying a point all the time. But frankly, the way you evaluate whether you should pay points or not pay points, just generally speaking, is the same way you evaluate whether you should refinance or not. So remember when we did our deal, right? I was telling you, I tell all my clients this, when you're looking to do a refinance, it's great to save money monthly, right? It's great to lower your interest rate, sure, but that can be misleading. So the real evaluation of whether a refinance makes sense is how long do you have to be in the new loan where the savings make up for the costs of the loan, right? The metric is 3 years. You should never do a refinance unless you are literally getting on fixed income and you're retiring and you know that your one spouse is going to be out of a job and you're not going to be able to qualify for a loan after this, right? Rare circumstances. Right. But generally speaking, 3 years is the metric, 2 years is the goal. 90% of people should refinance if the break even is 2 years or less, because that means even if rates go down, right, or something happens, you sell the house in a couple of years, you at least broke even, right? It's a nice hedge. So it's the same theory with points. It's a little bit longer. The metric, depending on how long you're going to be in the home, could be about 3.5 to 4 years, where paying the extra point, right, that extra money up front over time, how long does the lower rate take to break even on that? And so we use a similar model. If it's 3 years or less, consider it heavily, right? Even if it's 4 years, depending on the time in the home, you may consider it, but typically 2 years or less, hey, do the point. It's a no-brainer. But if it's more than that, you really got to think twice. Most of the time, I don't like paying points, especially in the environment we're in, because you do sabotage yourself from refinancing later, because you keep paying a lot of money to get a lower rate. And then if the rates drop, well, you really can't refinance because you got to wait till you pay those costs back.
Right. Yeah, because it extends that payment period.
Correct.
Extends the break even, right?
Correct.
There you go.
That's a good way of looking at it. And I like that you kind of made it analogous to the same way that you would decide whether you should refinance or not. I know in our office, we get that question a lot. And I usually just defer and say, you need to go talk to Andy. He will do
Right.
the analysis and let you know where your break even is, and then you can make the decision.
Yeah.
But is there a way for someone to just, if they're glancing at their mortgage statement, is there a rule of thumb for when they should at least think about initiating a conversation?
Well, boy, that's a good question, Mary. And there's the challenge in answering that is that, if you give a rate thing, it used to be, hey, if you can drop your rate 1%, right? If you can drop your rate 2%. But that really depends on what are you paying to get the rate? And, lower loan amounts, like if you're under a $200,000 loan amount, it is very hard to save money on a refinance unless you're dropping the rate about 3/4 of a point to a point, because closing costs are fixed and they're a larger percentage of a smaller loan amount, right?
Got it.
And the rate drop doesn't save you as much payment, so it takes a longer time. So if you're in a bigger loan, if I could give a rule of thumb, keeping closing costs constant. Remember, there's 9 companies involved. Typically around, if you're in the 300,000 to 400,000 loan amount, it's around $4,000 or so in closing costs. If we're not
So
paying,
hold on,
sorry.
I totally interrupt you because you
Yeah.
just said there's 9 companies involved, and I know there have got to be people listening to this going, "What? I just thought it was the one person refinancing."
I just call Andy. Why is there 8
What?
other
Right.
people?
What are you talking about? 9 companies. So you finish your thought, but then I need you to come back to that.
Well, yeah, I know people are like, huh? What? Because yeah, we'll go back to that. So generally, the 9 companies involved and about 40 people involved in the average home loan. I know.
This is why I got out of that business. For anyone listening, I started my career in that business. And after 3 years, I became an advisor because I'm a control freak and there are too many people in that transaction that can mess it up.
Yes, it is challenging. We like to challenge, but yeah, most lenders just aren't set up for that, and that's why you get a lot of problems. But generally speaking, if you're in the $4,000 to $5,000 fixed closing cost range, because again, with all the companies involved, and you're in a $300,000 loan at least, then 3/8 to a half a point lower than your current rate is good to at least consider, have a conversation, right? May not work, but that's the closest to a benchmark I can give you. Is that helpful?
Yeah, I think
Yeah.
so. I mean, I think sometimes people just want a quick, like, should I even have this conversation? Is it worth the time? So
Yeah.
I think knowing if I look at this and I'm what did you say? 3/8
300.
to a half a point above whatever market rate seems to be when I Google it, that
Yes.
it's worth initiating a conversation to have someone do a break even. Now, I could say most people in the mortgage industry don't do break evens. They just say, "Oh, you're
No, they don't.
calling to refinance? Great, we can help you," because that's tied to their paycheck. But that's one of the things that I think is really helpful with the way you do the analysis is that you just give people the information and then you let them make the decision. And that to me
Right.
is so key because that objectivity is missing from a lot of the information. That's part of the reason we wanted to have you on our podcast is that we know you're going to give people information that they can actually use.
Right on. Well, good. Yeah. Before last year, 90% because I do annual home loan reviews for my clients, and so 90% of the time I just tell them, you're good, makes sense. It's just part of the check. So last year was the first year that it flipped, right? It was like, oh my gosh, and many of my clients were like, finally,
Right.
it's been like 5 years. Finally, it makes sense. So it is a lot of fun to do it that way. But you're right, it is a lot more work, takes a lot more time, and lenders just don't want to do that.
Well, I like
Right.
that it's evidence based. It's not opinion based.
Right.
That to me is such a key. So okay,
Yeah, he
want to
gave
go
me a
back.
spreadsheet, Mary, and it
Your
spoke to my love
language.
language.
Your love language. That's amazing.
Right.
So, okay, wait. So go back to these 9 companies and 40 people. Like, I just want to hit on this really quickly because you're absolutely right. There are a lot more people involved in this transaction. And I can remember one incident in particular when I was in the business where we got all the documents where it needed to be, had an approval, and the process fell apart during doc review. And everything was delayed then getting to the title company and it delayed a closing. And I just remember being so frustrated because as the person who was interacting directly with the client, I bore the brunt of that, even though I had done everything in my power to get it done in the manner it was supposed to be done. So I do think it's really helpful for people to understand who touches that during the process.
Right. So I'm going to do my best to give you a 2-minute answer or less, some quick context first so we can remember the why, the arena we're playing in. So pre-financial crisis, right? It was the Wild West. You only had about 40 documents to sign. There were a lot less companies involved, a lot less regulation. But in those days, if a lender charged you higher rates and fees, they made more money. So what did they do? Well, charge you higher rates and fees, right?
Right.
So the good news for homeowners now is it doesn't matter what a lender charges you in rates and fees anymore. We get paid the same, don't get paid till the loan closes, right? One of the reasons interest rates are still really low, closing costs have been cut in half. But the flip side of that coin is we're highly regulated. So there was a lot more people and paperwork involved. There's about 200 documents to sign now. And yes,
Whoa.
there are about 9, depending on how you're doing it, 9 to 10 companies involved, 40 to 50 people involved, because there's all these third parties that lenders have to use to verify income, assets, to work through the attorney documents, the title documents. Of course, you've got realtors, inspectors, appraisers, underwriters, all of those companies and people, credit companies, all of it, right? And so you really got to make sure that you have a team to help a client through it. Otherwise, you happen what happens to you, Mary. And frankly, National Association of Realtors just did a survey. Almost 70% of homeowners believe their lender betrayed them, misled them up front, and it turned into what I call Jurassic Park at the end. They like to make it Disneyland up front, right? Get that stickiness. Then you get a contract and the dinosaurs come out. We flip that. And so, and the reason it's important to understand, because as just homeowners and people in the community, we helped cause that, right? Because we believe that loans are a commodity and that we can pick them up just like we're picking up something else, and we take them to the counter and check out, and we want that lowest rate. So the only way to cut rate these days is to cut on staff and products, right? So to squeeze out 1/8 of a rate, now you don't have good people back there, right? You don't have anybody that cares about the client, and people experience that, and train wrecks happen. And so we make up for any difference in rate because we watch the market. I invest in being a skilled, I understand stochastics, Fibonacci retracement levels, what's going on. I work with financial advisors so that we get you the best terms available in the market, but we don't sacrifice on team, because when you're buying a house, you can't afford that stuff. There's already enough stress going on. You got to trust it's going to get done. Is that a good answer? Yes?
Yeah, I think that's really helpful
Right,
for people to understand what's happening in the back end, because they just have the one interaction, and if you don't understand what's happening on the back end, you don't even know what questions to ask some of the time.
Can I say one thing on that too? Just
Yes,
COVID, because we got to remember, just fun, like last year, this was so evident and apparent, because lockdown policies are in different cities and states, and people would have COVID at the office, the whole office shut down. Well, there are about 5 regulated companies that all lenders use, the same ones, right? So they get congested. The amount of follow-up that has to be done, and had to be done then and now, is incredible. I had to hire an extra staff person that literally just follows up with third parties every single day, all day. Otherwise, it just won't get done. So it's a really important thing to also, for clients, if you are buying a house, do not get a pre-qualification. You are not pre-qualified if you haven't sent all your income, asset documentation, not just had a credit pulled, had a verification of employment pulled. Get it all done before that contract. You'll have a powerful pre-approval, more powerful pre-approval, so you'll be more competitive, and you can have a quicker closing because all of that stuff's done. You just have to get the contract, appraisal, and close. That's the way to do it.
So Andy, I actually want to hit on that, because I think what I just heard, I think that the people listening might want a little bit of clarification.
Sure.
Can you just real quick, and you kind of answered it already, I just want to make it really transparent. What is the difference between a pre-qualification and a pre-approval?
Great question.